So a very warm welcome to our webinar today. Today's discussion focuses on the results of our Global Investor Relations Survey conducted at the end of 2021 and its related report, An Unfinished Ecosystem, the Ever-Changing Face of Investor Relations. The survey was a collaboration between Edison and Debbie Nathan Associates, and it was set against a period of tremendous change, not only for the IR industry, but also for society and business as a whole. And I think the threads of that change are borne out by the results of the survey, both in terms of the information on the here and now, but also as an indication of the direction of travel for the industry as a whole. It identifies trends that will require a response from investor relations, industry and professionals in terms of innovation and transformation to meet the new challenges. I'm delighted to welcome today two distinguished panelists. Firstly, Debbie Nathan from Debbie Nathan Associates. Debbie, perhaps you could give a brief introduction.
Hi everyone, I'm sure most of you have spoken to me or heard of me, but for those that haven't, I run DNA, which is a search firm that focuses exclusively on IR and comms. It's very much an industry that I know well. I spent the first 10 years of my career in IR in FTSE 100 and 250 businesses, and then I've spent the last 7 or 8 years on the search side, working across different geographical markets, but as I said, exclusively within IR. And I look forward to joining the panel.
Thank you, Debbie. And secondly, we're joined by Edison's own Patrick Yao. Patrick, could you say a few words as an introduction?
Yes, certainly. Thank you, Tom. And good afternoon, everyone. Thank you very much for joining us today. I'm Patrick Yao. I'm Managing Director of Strategic IR on the European side at Edison. Prior to this role, I was IR with a couple of listed companies. So for any IROs on the call today, I feel and I understand your pain, and hopefully we can help you through some of those pinch points during the course of the discussion today. And prior to that, I was on the research side for over 20 years as an analyst. So drawing on some of those skills as well. So looking forward to the discussion later on.
Great, thank you, Patrick. So the webinar will cover 5 key areas in terms of the findings of the report, and each area will be spending approximately 5 minutes discussing. So this splits out into part 1 and part 2, which focus on salary, remuneration, job satisfaction and commitment. And then in parts 3, 4 and 5, we look at investor targeting, diversification, the evolving role of investor relations, and of course the hot topic of ESG. So Debbie, can I initiate with asking you just to cover off the key employment findings that you found in our survey?
Yeah, thanks, Tom. So yeah, delighted to be able to share the highlights of our survey that we did with you. We looked at demographics, remuneration, changes to the role over the last 12 months, changes to team sizes, job satisfaction and long-term kind of career aspirations of IROs. And as Tom said, I'll cover the kind of remuneration and how companies can attract and retain talent, what keeps people satisfied in roles, and then obviously Patrick will cover the targeting and ESG. But if we look at salary and remuneration, I guess, you know, what's been happening on the remuneration side, it does say kind of median salary of 90K with a, you know, that is across a huge range of respondents that participated in the survey, people of different levels of experience, people in different sectors. Breaking that down kind of one step further, I would say, just from my experience, anecdotally, you know, IR managers, the range is enormous. The range can be anything from 60 to 120 sterling on the base salary. Again, if you're looking at head of IRs, the one reporting to kind of C-suite, CFO, you're probably looking at a range of somewhere between 140 to 220. You know, the sweet spot maybe is about 160 to 180. You know, there is no consensus on salaries in IR. It is a huge range, and things that will determine that and vary that will be company size and sector. We looked in the survey at the bonuses, and average was about 45%. That's the cash bonus. Often there's LTIPs on top of that in the form of equity. Again, some sectors higher than others, especially in market turmoil. You know, some sectors are hit more than others. So some had 0, but average is probably somewhere across the 40 to 50 mark. In terms of what salaries are doing, I mean, it's without a shadow of a doubt, salaries have been rising and are rising. 50% of people received a pay rise last year, which isn't surprising. If you think about the role, like looking back kind of 5-10 years, the role is much broader and much more demanding. But in addition to that, I'd say there's a fight for talent, particularly at the mid-level. So teams are growing, and you know, clients of mine certainly, and corporates are having to fight that bit harder to attract talent, and also to retain people. You sometimes need to pay a bit more, so you pay more for maybe less experienced people. A third of IROs were dissatisfied with the base pay, and that's possibly because they haven't moved up with the market moving, as I just mentioned. So if you've remained pretty static over the last few years, but the market's moving, then that's going to kind of cause frustration. I guess, you know, it's much easier to get market rate or increase in salary when you move externally. It's much harder internally when you're in the same role or in the same firm, and that's possibly what's driven that number by of a third. I think we are in a dynamic market at the moment. As I said, I'd say usually the IR market's oversupplied with IR talent. And I think that's probably still goes true at the senior end, but at the mid-level, manager level, clients and corporates have to think creatively about how to attract people. Do they train people from other fields? Do you take people from FP&A or M&A? Perhaps people from financial comms. Another way that some people are looking at it is actually offering flexibility. You know, working from home will allow, or hybrid working will allow people to attract a wider talent pool, because you can tap into different geographical markets. You don't need to just look in London. If you're based in London, you can look across the UK or even in Europe. And the final point on this, I'd say, is well, 30% expect IR budgets to increase over the next 12 months. And perhaps that's unsurprising as well. That will be partly due to talent and team size growth, but other factors play into that, including kind of technology and other forms of investment that IR teams are making. If we move on to kind of looking at job satisfaction and commitment, 70% of IR respondents who are working in-house said they felt more valued in the role than previously. And actually looking at those consultants who work within agencies, 42% said they felt correctly valued by clients. And one of the interesting things I think about IR is it's a really privileged role. You work really closely with senior management and board, and you're privy to information that many other people won't be. Sometimes you're the first one to know of certain transactions or corporate activity. And I think that privilege often leads to job satisfaction. The sensitivity of the information you're dealing with, makes it exciting. 74% of respondents told us that they do see themselves in IR in the next 5 to 10 years. And the remainder actually had their longer term focus set within kind of the ExCo or management or CFO, which, is a natural next step for IROs. So again, not that surprising. I think the interesting thing about IR is it's a career with longevity. And, as Patrick said, he's made the move over from sell-side to IR. Many capital markets professionals have transitioned across to IR over the last kind of 5+ years. And possibly that's been triggered by uncertainty in their models and what's going on the sell side. And if that lacks longevity, a career in IR utilises their skill set and their talent and their knowledge of the capital markets, but in a more stable environment, perhaps. 72% of respondents said they felt a career in IR was rewarding or extremely rewarding, which is nice. I think it's probably higher than potentially some other professions. And the final thing I'll say is actually getting the right KPIs to measure success, and that's individual success, not just team success, is really important to enhancing job satisfaction and retention. So I think I would encourage people, corporates, employers, to think more broadly about how you measure individuals' performance. It, clearly can't all be about share price performance, because many factors play into that, which are out of the individual's control. But depending on what the objective is of the IR program, is it to diversify the register? Is it to increase analyst coverage? Whatever that might be, you can tie that into the KPIs that individuals are measured against. And when there's a sense of achievement, that's when you'll get your, retain staff. So that's a snapshot, but I'll hand over to Patrick to cover your areas, and then here for Q&A afterwards.
Great, thank you, Debbie. Patrick.
Thank you, Debbie. So let's look at targeting and diversification. So where is the IRO's attention these days? What sort of investors are they looking for? And perhaps let's touch on the geographies where those investors might be found. So one of the surprises perhaps of the survey was that 22% of respondents didn't target institutions at all in their investor targeting. Now, perhaps here there might be a nuance in the question, whereas IROs clearly do speak to institutions, but perhaps the targeting part of that activity is still being done by the traditional advisors and brokers in the market. So once we start to try and analyze that, maybe it's not quite so surprising. But certainly from my experience, the IROs that I've spoken to and some of the things I was doing myself was actually to bring that targeting activity more in-house, particularly as we bear in mind the changes that have happened in the marketplace over the last 2 or 3 years. The institutions themselves are becoming much more focused on passive investment strategies. Algorithmic trading has become quite well established in the market. So the amount of active money and active investors in the market has reduced. So maybe that explains why some of the institutions are less targeted than they were previously. However, when we consider the structure of the market, we need to think about the retail and other investors. And again, one of the slight surprises for us was that despite the acknowledgement that retail investors can be quite important to the direction of a stock, providing that marginal and directional trading capability when you aggregate what they're doing, only 35% of IROs targeted the retail investment community, either directly or through private client or retail brokers. To me, that was quite a surprising amount, given, certainly from my background, I was spending a reasonable amount of time on the road with retail investors, doing specific retail investor roadshows in various regions of the UK. And those retail investors can actually be quite powerful in their ability to either invest in the company or change the direction of the stock price movement. So I would say, ignore the retail market, perhaps at your peril to some extent. There were few surprises when we looked at the geographic focus of activity. North America remains the most popular territory. It's the world's most liquid market, huge pools of capital out there, and to spend three or 4 days on the road doing North American clients, or these days, more likely on Zoom or Teams calls, is a very efficient way to get into some large pools of capital. Secondly, we found that over 40% targeted the Australasia region, which to me is a slight surprise given how diverse and far away those markets are. But perhaps that's also the effect of Zoom and Teams on the roles of IROs and what they do today. Clearly, time zones make that more challenging than the US. But nonetheless, there are windows in the day where you can engage quite effectively with investors in those marketplaces. And then, again, slightly surprisingly, more than a quarter of IROs were targeting Scandinavian investors. Typically, one might expect that number to be more applicable to the more established markets like France, and Germany, but Scandinavia has also now become quite an interesting area of activity for IROs. There's some big pools of capital. And again, it's relatively efficient for IROs to tap into those markets with their management teams, with their road showing activity. And very time zone friendly as well. Next, if we can move on to actually how we target. So clearly we've been through an unprecedented phase in our experience as a society and as an industry. Digital technologies have really come into the fore, and that's had quite a profound effect on how we target. But our sense is very much that the data is telling us that we are only partway through a transformation of how we engage and how we target investors for our equity stories. So despite the end of lockdowns in some countries, almost a third of IR professionals had no face-to-face investor events at all. Perhaps that's not entirely surprising, given that we need to be cautious and mindful about health and the safety of our investors. But that number does seem a fairly sizable proportion. And clearly, the bulk of the meetings have been in the virtual format. And interestingly, a third of people we surveyed almost felt that the virtual meetings were much more effective. Typically, they can be a bit shorter. You can put more virtual meetings in. It's now just as easy to share materials in the virtual world. And although you don't get the nuances of the interpersonal physical experience, the convenience of having a virtual meeting possibly outweighs that. Interestingly enough, around 30% see little difference in the effectiveness. So, this data tells us that roughly a third fall into the various camps of either more effective, less effective, or no impact in moving to this virtual world. I think that equal split, again, I think suggests how deeply embedded now digital is within what we do. And it's just become part and parcel of every day. So despite that, I think what will be interesting is where we go from here, given that the announcements yesterday across the UK and perhaps to be followed later by other countries that we're now abandoning most of the restrictions, in fact all of the restrictions around COVID, whether we see a return to more physical roadshows. Certainly across our client base, we've not really seen a huge demand for physical meetings from investors. There are some pockets of that, but I don't think it's yet a sea change in the way we do things. And I suspect that going forward, it'll be some time before we move away from mostly virtual or hybridized meetings. And to service that need, we've seen a huge number of digital platforms spring up to service those markets very, very effectively. Interestingly enough, as part of the data, we found that digital marketing seems to have fallen behind a little bit, but I suspect that as people now, more fully engaged both physically and digitally, we may well see that digital marketing improve perhaps as we go forward. Another part of our survey materials which you might find interesting is that over 40% of in-house IR professionals use social media as the second most common channel. Again, charting the rise of that, particularly catalyzed by the restrictions that we've been through, is perhaps less surprising. So some interesting conclusion there on how we target. So now I'll turn back to you, Tom, to talk about ESG.
Thank you, Patrick. So obviously a very hot topic. And in our survey, 9% of IR KPIs are ESG related. And that seems slightly at odds with the amount of time people are spending focusing on ESG. So 58% of respondents spent 10 hours a week on ESG, and 17% spent more than that. And it was only a small fraction, 3%, that was spending no time at all on ESG. And we saw quite a dichotomy between the responses in terms of the time spent. And that's probably reflective also in terms of where different corporates are in terms of their targeting of ESG. And despite this, the scale of the opportunity that exists, and we know how much funds and the extent to which funds are flowing into ESG, only 35% of respondents were targeting ESG funds. And I think that the people that have seen the survey, that is very definitely lower than we would have expected, and we would expect to see that number rise significantly in the future. Patrick, I don't know if you've got any further thoughts on that. Yeah, I mean, without shadow of a doubt. So you're on mute then, Patrick.
Right. Can you hear me?
We can hear you now. Yes.
Yeah. I think without shadow of a doubt, Tom, ESG has become mainstream over the last 18 months or so. And actually, whereas a couple of years ago, we might have seen ESG and IR as separate activities and separate sets of disciplines. It's become fairly evident now that some of the more progressive companies are blending ESG in with their IR messaging, so it forms a natural extension and a natural part of how they describe themselves as a business, rather than as a separated or less integrated part of what they do. It's no surprise to me that 58% of IROs spend over 10 hours a week on ESG. It is the top topic. It's very complex. There are no firm standards yet established around ESG disclosure. So in many ways, companies are sort of feeling their way through this still, years after ESG legislation was first talked about. So a very, very complex topic. I think we could have a webinar on ESG alone and still not really do more than scratch the surface. But my sense is that, for the purpose of this conversation, ESG and IR are coming together. ESG is increasingly important, obviously, because of the screens that investors are now using to assess whether companies even pass the first hurdle. And if they don't have an ESG policy or an ESG approach for investors to consider, then they may not even get through that first initial checkpoint. Yeah. So ESG, extremely important. I wonder whether that 3% number next year will be 0%. I'm surprised it's not 0% this year, to be honest with you, given how important ESG has become. But certainly, it is a discipline that companies, whether they feel naturally that ESG is part of what they do or not, have to embrace now.
And is it fair to say it's a bit of a minefield for management teams, Patrick?
Yeah, I would, because of the number of agencies out there who are setting ratings for them, the number of different reporting standards and reporting frameworks. And, for many, it's yet another thing to distract them from getting on with what management teams do best, which is run their businesses. Yeah. So it's a very complex market. It's impacted by regulation. It's impacted by agencies who operate in one or more parts. And it's a very, very confusing part of the market at the moment. So that's why, the management teams are leaning more heavily on their comms teams and on their ESG, on their IR teams, to bring them up to scratch as far as ESG disclosure is concerned.
Great. Thank you. So that sort of concludes the formal presentation, and we can now switch to some Q&As. We've had a few questions come in, some good questions come in. So firstly, probably most relevant for yourself, Debbie, the question of how difficult is it to hire experienced IR talent right now?
Good question. I mean, what I would say is It's completely different depending on when you use the word experience, what level of experience. So if you're looking at the top end of experience, someone to lead an IR function, a head of IR, there's plenty of really good talent. I think at that level, what it comes down to is, there's been an exodus from the investment banks, etc. So there's a plethora of really strong, technically capable candidates. What it comes down to is the cultural fit, the sector understanding, and the personality rapport, all of that at that level. I don't think it's difficult, I would say, at that point. The entry point at the mid-level point, the mid-manager level, someone with 5 to 7 years of experience, that's where the fight is. So that's where all team sizes are growing, and that's the point that they're growing. You're not going to have 2 head of IRs, but you are going to have 2, 3, 4 managers to help manage things like ESG, etc. And that's where I'd say it's that bit more difficult. But the talent is out there. You just have to retain an open mind. Diversity is really key. You don't necessarily need someone that's followed the same career path as you. In fact, I would say you don't want that. You want the blend of skills in your team. So if you've come from a finance route, try take someone from a comms route, or if you've come from a sales side, try take someone that's come from an FP&A, because as long as your team has the financial literacy, the comms, the engagement, the building rapport, you want the full suite of skills, but it doesn't necessarily need to be all the same. And I think a lot of hiring managers fall into the trap of wanting someone like them. And actually, that will make the pool of talent that you can look in much smaller. If you open your eyes, you'll get a much bigger pool of talent. So there are really good candidates out there, but there's competition for the middle manager level now.
Right. And Debbie, I guess the hot topic at the moment is inflation. The Bank of England obviously trying to keep wage inflation down by encouraging employers to not let wages escalate. Are you seeing wage inflation come through in the recruitment cycle?
And I think, there has been a rise in salaries. I would say, whether that's linked to the direct growth in the actual IR role, I would say it's partly to play. So as Patrick just alluded, ESG is such a big part of IR roles that wasn't there 3, 4, 5 years ago. Remuneration needs to reflect that. So salaries are definitely rising, probably more than inflation, and they're going to continue to rise. I also think that graduates, entrants, straight out of university, those candidates are being paid way more than ever before, and therefore it's an escalating, not problem, but it's an escalating domino effect that, where you used to pay X amount for someone with 5 years of experience, you're now paying X plus for that same candidate, same experience. So, yeah, salaries are definitely rising.
Great, thank you, Debbie. And I've got another question here, probably directed at yourself, Patrick. Have most listed companies got to grips with the new breed of retail investor? I think actually quite relevant, considering that the survey was conducted at the tail end of last two, the growth of retail investors, the situation with Robinhood, etc.
Yeah, so if by new breed of retail investors, we mean more social media savvy, perhaps younger than the previous generation of retail investors, then I'm not. I think the picture's pretty mixed. I mean, the stat I threw out during my piece about targeting, 43% of in-house professionals see social media as their second most used route or channel to market after email. Then I think it shows that some companies are responding, but my sense is that some companies need to think more carefully about their social media profile, whether it's on LinkedIn. What their Twitter output is like, how they're reaching out and how they're touching, and also, they need to be very consistent in how they express themselves through their website, through the materials, through their social media profile. Because if there are inconsistencies there, these savvier new breed, as the question puts it, of investors will pick that up and they will question that, So the level of scrutiny that companies are coming under because of the immediacy of social media, I think, is having a big effect. So the answer in short, I think, is that there is some understanding there, but it's quite patchy.
Great, thank you. And a further question is, how long do you feel it will take for ESG to be fully incorporated into everything that IR does? Patrick, I'll turn to you, and then maybe Debbie can share some thoughts as well.
Yeah, you know, my feeling is that it needs to be, you know, part of that now. I don't think that we can, you know, companies who want to progress it, I don't think they can afford to hang around too long. Partly because some companies will fall under legislation. So TCFD disclosures and so on are now in force for companies of a certain size on certain markets. So that needs to be addressed. So regulation will push them along. But I think as the ESG becomes further and further embedded, you know, the performance of ESG funds and the companies within those funds will become more and more evident. And you'll see a gap, I think, develop between those who have an all-embracing ESG integrated IR approach and those who feel that ESG is something that they don't need to worry about today. I think that performance gap will start to show itself.
And Patrick, do you have any advice on how to attract new pools of retail and how to manage communication with them?
I think perhaps it goes back to, you know, the comments I was making about the new breed of retailers. I think these days you need to make sure that your communications are consistent across all of the different channels to market that you operate, both your traditional channels and your social media channels. I think that during the lockdown, investors now have become used to be able to access management teams across all sorts of retail platforms, which bring teams and retail investors together. So that momentum that's been built up needs to be continued. I don't think, you know, companies can afford to ignore the retail market in the way that perhaps they used to do in the physical world, where, you know, the retail investors, you have to spend quite a lot of time on the road to reach them. Now, because of, you know, what's happened digitally, they're there instantaneously. So, you know, that's what you've got to be mindful of. You've got to build those routes to market. You've got to really make sure that your social media communications is consistent, is right, and is in tune with your key messaging.
And another question that's come in is, which investors do you think are most underserved by most listed companies in your experience?
So that's a good question. I think in some respects it depends on what market you are. I mean, you know, we spent a little bit of time talking about retail investors, and only about a third of IROs targeting those. So, you know, you might argue that they are perhaps underserved there. Whether companies want huge amounts of retail investors on their share registers is a decision for them to make. You know, in some parts of the world, such as America, for example, you know, the pension fund industry is relatively ignored because they tend to invest once and never again. So, you know, they're not that popular with the brokers who like to see people trading stock. So I think it depends on the geography, but certainly the retail market, the family offices, the high net worth individuals, these have been difficult to reach pockets of capital in the past. But now, as I say, social media and digital platforms make those audiences far closer to us. So those are perhaps, I think, areas where, you know, more attention could be paid.
Great.
Tom, can I just jump in? Sorry, just
yes,
on the previous question about when ESG will be fully embedded in IR. From a recruitment and talent perspective, I would say it's 100% already embedded. It is now becoming a point for selection of candidates, a criteria that clients will use to determine who to shortlist and who not to. And I've just had this very scenario with a FTSE 250 who've just hired a head of IR who was starting to think about their strategy around ESG, how to build a team, who to hire. And actually they said to me, do you have candidates that would have already got IR and ESG experience? And lo and behold, the candidate that's got the role has done many years in IR, but equally their last role is in a sole ESG and sustainability role. And that's really, really attractive for a client that. So from a talent, if you want to enhance your career, and if IR is for you long term, you cannot avoid having ESG on your CV. In fact, you need it there to basically make it into shortlists. More and more clients are now looking for that. And if it's not on there, you know, there's all sorts of accreditations. Previously, they'd look for CFA, CIMA, ACA. Yes, they still look for that, but now there's the CFA, there's there's universities that are doing ESG certifications, which are becoming much more prominent when looking for talent.
Great, thank you. And I've got a further question actually for you as well, Debbie, is in terms of average salaries, do you see a significant drop-off and difference between when people are stepping up to managerial roles?
I mean, I think the manager, there's quite a difference between, I think the question is kind of, is there a drop down to manager levels? There's quite a big difference between a manager level and say a head of IR level, yes. And I think, you know, often that just comes down to people's experience, whether they've been in the markets prior to moving into IR. It's really hard to answer that one because, as you've probably alluded earlier, there's just generally no consistency at all in IR for various reasons. But I think, you know, you get the biggest jump up when you do the kind of head of level, and the manager level would be substantially below that usually. And obviously, you know, again, the 3% that we talked about earlier in one of the stats that spend no time on ESG, it's possibly, I was thinking, taking me back to my time when I was in Barclays in the IR function, and there was 15 of us in the IR function. Our role, that was my first IR role, and the roles were very, very siloed. So one person would look after the 30, or two people would look after the 30 analysts covering us. One person would do disclosure, you know, one person would do corporate access and roadshow. So because you had siloed roles, it's quite conceivable that 3% is from a team that was so large that individual who completed that question doesn't actually do ESG. Yes. I think, you know, other than some of the very large banks and very large cap businesses, it doesn't really work like that anymore. Teams are much smaller. So you do tend to get involved in much more.
Great. We've obviously got a number of additional questions coming through, but we are probably at our allotted time. So it's been great for everybody to join, and thank the panelists very, very much for their contribution. On the screen at the moment, you have our email addresses. If you've got any further questions, please do contact us. And you can see here a link to where you can get a full copy of the report. And look, we look forward as a business to plenty of dialogue around its findings in the future months ahead. So just thank you everybody for attending, and thank you very much for the panelists.